Hello, welcome back to CRE and More Episode 8, where we talk about commercial real estate and more. This is your friend, Realtor Tom Tseng, and my co-host, Simon Yeh.
Hello everyone, welcome to CRE and More. And today we have our trusted partner and friend, Joseph Green, and he is here to share with us on how to save on tax by doing some of the things he does the best.
Thanks for having me, guys. Happy to be here.
Nice. Joe, can you tell us about what you do?
So, I have been working in the life insurance industry for a number of years now, and I'm in the same networking group with these wonderful gentlemen. And basically, I help business owners get to the 0% tax bracket in retirement. Mm-hmm. So, like most good stories, it starts with a girl. I was working as a boarding school teacher for a number of years, and before that, I had been, I think I taught my first students when I was 12.
As a tutor?
Yeah, as a tutor. I had 6 Latin students.
Oh, wow.
Over the years, I think I've probably taught probably 300 something students.
Oh, wow, nice.
Yeah, and I've taught everything from Latin, geometry, AP Bio, to just, even theology at one point when I was in high school. And, I finished up school at UCLA. I needed a job, so I went out and became a teacher because that's what everyone in my family does. My mom's actually a professor of art history at UCLA, and then I think now at Oxford University in England. Yeah, in England. And then Dad's an attorney, but my grandmother was one of the first Mexican American women to actually get a teaching credential in the United States.
Yes,
I know. I don't know how it happens, but you take a Russian Jew and you take a Mexican American and you put them together and you get an Irishman.
With an Irish accent.
Yeah. By the way, I have red hair for anyone who's not watching the video.
That's cool to know. I didn't know that.
Yeah.
So you can whip out some Spanish.
Oh, I don't know about that. I'm okay. Hablo español más o menos.
And what made you come into the life insurance industry?
Like I was saying, girl. I was dating somebody at the time very seriously, and we were thinking about having kids and getting married. And basically, we had a conversation one night that went something like, you need to be doing something more lucrative than just teaching. Mm-hmm. I had a small college advisory at the time, which I'm still a part owner on today.
Oh, nice.
And it's been very successful the past year on my TikTok. But it's not my main business these days. Mm-hmm. And I just was looking for something different. So I sat down, and I had a back injury at the time too, so I couldn't walk very well for about 3-4 months. I was in a lot of PT.
Wow.
Yeah. And I thought very hard about what I wanted to do. And there were a few things that I sat down and said, okay, I need this. It needed to be in an industry I thought was ethical. I didn't want to be doing something I felt like was not adding value to people's lives, or was taking advantage or swindling them. And so I did a lot of research on several different industries. The other thing was I wanted it to have a scalable income potential. I did not, I think I read Rich Dad Poor Dad around that time, and I really resonated with it because, of course, I had a parent who was a teacher, professor, just like him.
Right.
Yeah, just like the dad. And my grandfather had been a businessman. He actually had worked at Mass Mutual and was a $1 million roundtable agent for, I want to say, over a decade. But I didn't really understand much about it. I just knew he was a businessman. And so I sort of looked at that and it's like, okay, I want to do something like Grandpa maybe. So money had always been an interest of mine, even when I was, 6 or 7. Ethical, scalable income potential, and it had to be an industry where I knew I was willing to work more than 90% of the people who worked in that industry. So I actually looked up the number of hours people worked in a bunch of different types of industries with scalable incomes. Mm-hmm. And I realized that my work schedule I already kept was way more than sort of the average life agent out there.
What else have you learned from Rich and Poor Dad?
I remember what he talked about was silver very well. I actually remember his passages on inflation the best. Was at the time. I really had a revolution in my politics at the time as well. Previously, I'd sort of been very far left. That how I was raised by my mom and more involved in activism. And sort of in college, as I engaged with that world more, I became more disenchanted by it and became a little bit more interested in sort of, I guess, Chicago School of Economics, Austrian School of Economics, more libertarian economic outlook.
Gotcha.
And the inflation passages really spoke to me because I saw how it robs sort of our poorest citizens and stops them from being able to save. I mean, really, it is a tax on savers, and it's a tax nobody votes on. And so that's really one of the biggest concerns I have for myself and my clients a lot of the time.
So back to, the reason I asked you about Rich and Poor Dad, because the goal for Robert Kiyosaki, his message is for people who want to become financially or time freedom, you got to create passive income.
Yes.
The passive income has to be greater than your monthly expense. One way to do that is reduce your expense. That will include everything that you spend on. Also, tax liabilities. And that's, we're not supposed to give tax advice, but we are giving the general concept on the whole thing, right?
Yes.
So in our world, we deal with business owners, investors, and all the other everyday person. Our goal is hopefully one day we can achieve like the wealthy people does, generate enough passive income, and then hopefully the passive income will be greater than your monthly expense, then you don't have to work.
What are your plans after that? I mean, once you get there, let's say tomorrow you win the lottery and your passive income is way larger than your expenses. What would you do?
Winning a lottery, unless you take the monthly portion, it might be large, right? So then, in the concept is that you set a goal for yourself, because when you reach to another level, you want to set up other goals. And you don't just stop there, and you don't want to spend it all. I mean, some people win a lottery and then
it's gone again. Yeah.
So as an investor, and also advisory to our real estate investors, we want to keep that flow going. But at the same time, when you buy more, you might have more liabilities, also more expenses. Then you got to create more income, right?
Do you believe there's really ever a time where someone can truly stop working after they've gotten enough assets? Or
through my network of friends, there are people that is continuing working. But when do you stop? And what's driving you? What's driving you?
I see.
What's driving
the
you?
motivation changes.
Exactly. What is more important to you or one person in your life? Is it your family? Is that the biggest motivation? Or is it something else? Or is that the $1 million mansion that you want to purchase? Is that a Ferrari or a Lamborghini that you want to purchase? Or something nice? What motivates people, right? So that's the topic that you can share with us. How you help your clients with their either tax saving or creating wealth.
I usually have two different types of clients, broadly speaking. One type, and this is super generalized, but one type is in the 50% tax bracket. And they need tax relief today.
And when people are in 50% tax bracket, that means they're making well over what?
Well over, no, it's like $500,000.
$500,000, right?
I think the normal rules of money begin to break down when somebody starts to make about $500,000 or more. If you're a normal couple, let's say, imagine Joe and Mary, and they're both making very good money. Let's say they're in the prime of their careers, $100,000, $200,000 a piece, and they're very well off. They're happily upper middle class. Those people are not going to have that much available to them in tax savings. Obviously they have the depreciation on the real estate that you guys can take care of. But most of the time, if they're not running their own business, there's not a lot they can deduct. And so the idea of getting to a place where they're really seriously cutting their taxes in a big way, it's just something that probably is not in the cards for them until retirement.
I see.
For those people, my goal with them is to set up 5 to 6 different streams of tax-free income.
Okay.
And I gave you the book on it, but David McKnight, the CPA, is actually really famous for this book, Power of Zero, where he actually outlines exactly how you get there.
Oh wow!
And does a better job than I'll do in 5 minutes. But if I can, let me see if I can do it quickly. He advises people to try to get their Social Security to be tax-free by limiting how much taxable income they're reporting.
Sure.
And if you can keep it below these Social Security limits, either through just not having any reportable income or having it canceled out by, say, the standard deduction, if they're not lucky enough to have a bunch of new real estate acquisitions all the time, that can actually keep the Social Security tax-free and up to the standard deduction in their normal income, say from an IRA or a pension. The next step, of course, is going to be the Roth. And I'm not going to talk about what we put in there because I don't want to be a bad boy that gets in trouble for the security stuff. But the Roth IRA, of course, young people, this is such an important thing because you get to put the money in and it just grows completely tax-free. And I think some of the laws changed on it too, so it's a lot more liquid now. And it's amazing. Everyone. Well, I'm not going to say that actually. I'm going to refrain from saying that. But it's a good thing for many people to have.
Sure.
The biggest problem with it, of course, though, is that you're very limited in what you can put away.
Right.
I think the limit right now is about $7,000 a year, and that just simply is not enough for most people to.
Is that also depending on how much you make a year?
Yes, there are going to be some people who they make too much.
Right, and they can't even contribute.
Yeah, and that's just out of the question. For those folks, sometimes they'll have a Roth option on their workplace 401k, but there are a lot of workplaces that don't even offer that necessarily. And you have to remember too, on average, it's going to be more expensive to participate in a workplace plan. Not always. I've seen some amazing standouts, but it's usually more expensive to participate in a workplace plan than to just set up an individual thing with, whatever you're going to do.
So to clarify, Roth is self-directed, and it is after-tax money that you can put into a Roth IRA account.
Exactly.
Now, when you invest with that money, once you make money, you put it back. It's actually tax-free because it's been taxed before. So just want to clarify that if that's correct.
Yeah.
All right.
So the last thing that, and this is where I come in, is there's one more very awesome asset that a lot of people don't understand or know about, or they know about it and it's been designed incorrectly, is an overfunded cash value life insurance policy. Overfunded is the key word here. I would say 99% of agents in the field actually do not know how to set this up, or they do know how to set it up and they choose to set it up wrong because it affects their commissions a lot.
I see.
When you set up one of these things properly, it cuts the agent commission by about 70-80%.
Oh wow.
Yeah. So I will venture to say that most agents out there just either don't know how to do it or will not do it because they can't make a living doing it that way. I would venture to say they can't make a living because they're not talking to the right people and they're not being transparent and honest with their clients. And if they would do that, they would have more clients and better clients and people willing to give them more money because they're proud of what they're putting together. The optimal blend, I would say, for this is you're trying to buy as little insurance as possible. And it seems counterintuitive here.
Yeah.
You're trying to buy as little actual insurance as possible and put as much money into the cash value of the policy as possible.
So when you say buying as little as the coverage or?
Yes, the death benefit.
Death benefit, okay.
The IRS says there is a certain amount of insurance death benefit coverage you must have in order for this to be considered an actual life insurance policy. We need to make sure we meet that, and there are two tests that they have. I believe it's the guideline premium test or the 7-pay test. I won't get into that. It's super complicated. We'll let a tax advisor deal with that one. But most agents don't even get anywhere near the limit of those tests. When you have a properly designed cash value life insurance policy, you are trying to get right up near that. Because you want to be paying as little as possible for insurance and as much as possible into the cash value of the policy, which is what's actually growing the amount of money and growing how much you have access to. And the beauty of it, of course, is that because you are technically borrowing against the policy.
That's
when
right.
you access the money,
That's right.
it comes out tax-free because
That's right.
loans are not taxable.
See, not a lot of people explain like you said. We meet a lot, we know and meet a lot of life insurance agents.
Yes.
They only tell you, you can get tax-free money. They don't even tell you it's borrow against,
Yeah.
The keyword.
Yeah. Well, but borrow against is such an important keyword here too, because I think it actually makes it more understandable for somebody who is sophisticated, and especially someone who has experience with real estate investing.
So previously, because I wanted to ask this question going back to the Robert Kiyosaki.
Okay.
He was talking about the real estate passive income.
Exactly.
And I thought, if you're a subscriber to his book, maybe you should be a realtor instead. Why life insurance? And you kind of helped explain that, because I feel like we're helping clients grow their assets, try to gain it, grow into a bigger value. And I always thought life insurance, watch after you're rare, watch after I die, and then we'll kick the bucket, and then so a payment can get the house.
Yeah.
But now I think you're introducing a different way, because maybe these people who are having a 50% tax now put their money aside into these overfunded insurance policy. And then borrow against it. Maybe you'll charge an interest, maybe 5-7% or something like that.
So here's actually where it gets very good and begins to look a lot like what you do with clients. There is an interest rate in theory, but if you have a whole life mutual company, there are very few companies that do this well. I would say there's probably less than 10 on the whole market that are really designed to do this, and not all of them like to be known. So I won't name them all.
You gotta call Joe for it.
But a lot of these companies will actually make sure in the contract that the rate at which you borrow is lower than the rate at which you're getting credited. And they've been doing this for decades, if not longer. Some, it's a little more of a gamble, right? Some, especially for people who are getting into like an IUL, for example. Those ones, there's a much higher possibility for upside potential, right? A lot of those indexes that are connected to the S&P's performance.
Joe, can you tell the audience what IUL is?
Yes, okay. So there are two main types of policies that you can do this sort of cash value overfunding with. The first is the traditional one, which is a whole life insurance policy. And you really want to make sure you're getting it from what's called a mutual company, where the policy owners are actually the owners of the company.
Okay.
And the reason you want to do that is because those companies are built for longevity.
Right.
A lot of them are over 100 years old. The company I started with, Guardian, for example, started out as, I believe, Germania Life Insurance back in the 1870s, maybe. It was a Lutheran German life insurance company for all the new immigrants coming in at the time.
Okay.
But those portfolios are set up for the policies to be in existence for the life of that person.
Okay.
They're not responsible to individual stockholders in a stock company, for example, to make profits for you every single quarter. And that's when you get a little bit of volatility, I would say. Now, that is a very traditional approach, and in those types of policies, I would usually recommend that you want to have, for every dollar that you're buying actual insurance with, you want to overfund it anywhere between $7 and like $9.
Okay.
Why so much?
Because you have more liquidity on day one.
And those money are
that money,
after tax money or before tax money that you contribute?
That's a complicated question, but usually after tax, like a Roth IRA.
Okay.
But the other one is the IUL.
And what does it stand for?
Index Universal Life.
Right.
There are some other options out there as well, but again, I'm very limited by my compliance sometimes, so I don't want to put my foot in my own mouth.
So what's the difference between whole life and IUL?
The biggest difference is that when you start, the IUL is going to be cheaper.
Okay.
So if you are young, healthy, and wealthy, I think that's oftentimes the way to go.
Okay.
Because the cost of insurance is going to be dirt cheap when you're young.
So like in your 20s, 30s,
20s, 30s, even a healthy 40-year-old, I think, could be a
Okay.
good fit for it.
And what about when you're in the 50s and on?
And yeah, when you're a little bit older and the cost of insurance is a little more expensive, that universal life chassis is going to keep getting expensive more expensive each year, like annually renewing term.
Sure.
But with a whole life, it starts out a little bit more expensive, but it is a flat rate for the rest of your life.
Oh wow.
So there's a little bit more predictability.
So
It's not going to go up in price.
I see.
Where people get in trouble sometimes is they start an IUL when they're 60, they really underfund it, and then that thing just cannibalizes itself.
Wow.
And there's no money left in it. And I see those policies all the time because agents do not design them right.
Gotcha.
Agents are not incentivized to overfund the policies.
Mm-hmm.
When I overfund a policy, I make, I believe, depending on the company, it's like a 2 to 3% commission on that money.
So
But on base premium, on the actual money that's going into buying insurance,
right.
you can make anywhere between 50 and 100% of the first year.
So I was
commission.
gonna say, you guys get paid on the insurance portion, not overfunded.
You get
little
paid
bit.
a little bit on the
Yeah.
overfund, but it is significantly less.
So typical agent would not incentivize
Exactly.
themselves to do this
Mhm.
for the clients.
I want to make sure I hear one thing right. You
Yes.
mentioned that the interest rate that you will be borrowing against you will not exceed the interest. Is it like, for example?
For the companies I use, for the companies I would use, yes.
Okay, but not for others.
Not for all of them, not most of them.
I
The
see.
vast majority of companies will not do that.
Yeah, that's why I thought it goes with the market, but this is a keyword. It's just like if I'm depositing my money in CD, which is like pretty much sure to grow.
Mm-hmm.
And if it's only 2%, then I'm only borrowing at a 2%. It kind of locks your risks. So at least you are just even out. The most you have is even out that year. Is that right?
It really depends on the company. Every contract is going to be different. But when I'm setting up a policy that somebody wants to do arbitrage in, like what you do with the houses, I make sure to set them up with a company where either it's likely the index and the universal life will outperform the interest rate being charged, or if it's a whole life, it's a company where the dividend outperforms the interest rate on most years. Of course, you cannot guarantee that. There are contractual guarantees in there, but that's why it's so important when you're looking at the right company.
Tom, did you get what Joe just mentioned? So for example, your policy is making 8%, right? And he makes sure that 8% outperforms the interest that you pay, which is at 7 or 7.5.
That you really want to find companies that are going to do that. When I first got started, for example, the company I was with, I believe, charged a 4% interest if you were going to borrow the money.
Okay.
And then they had two crediting options.
Okay.
You could either get a dividend, which at the time was 6%, and this is usually conservatively invested into the company's main account.
Right.
This is a mix of government bonds, company bonds, that sort of thing.
Right.
And then you could also put money into an index, which mirrored the performance of the S&P 500 with a floor of 0,
Wow.
and at the time a cap of 12.5%.
Okay.
So you're not going to get a crazy 40% return or something, but you have a lot of downside protection. So it's for somebody who is interested in collecting arbitrage and trying to run money through the policy and then put it into other places like real estate, for example, or it's for somebody who needs the tax-free retirement.
Got it.
So you mentioned about the floor, because tying with the market also I'm concerned about volatility. So by having the floor of 0, meaning if the S&P sunks the next year,
You're protected.
Okay.
It can be a brilliant part of somebody's overall portfolio. There are other products that do this too. I mean, a lot of people get scared of annuities because they're imagining, I like to think they're imagining the J.G. Wentworth commercial from the 2000s with the opera singers, where they're saying, J.G. Wentworth, 877 count it down, you know that one? Where they're offering to buy an annuity. People get scared of those, I think, because they're worried they're going to be locked in forever and they're never going to be able to access the money unless they take a stream of income. But most modern annuities are just a lot more flexible than that. There is a lock period, obviously, on it, but once that's done, it's very easy to exchange it for another annuity tax-free. You know, like the 1031 exchange?
Yes.
On the real estate?
Yes.
Do your viewers know that?
I hope they know by now.
We can have another episode about 1031 exchange.
Yeah.
So in life insurance and annuities, we have a parallel thing called a 1035 exchange.
Oh, wow.
Where you can actually exchange the cash value in an annuity, a life policy for an annuity or another life policy, or an annuity for another annuity.
It has to be equal or greater amount? Similar to just 1031 or?
The money has to be there, right?
Okay.
The money has to be there. So you can't exchange a policy with 100,000 cash value for $1 million cash value.
Right.
But you are able to really move it to where now with the life insurance you have to requalify for it. That's why it's kind of scary for some people. But for an annuity, of course, there's no health requirements for an annuity. So that can be a good option for some people. And of course, on the annuities, a lot of them have that feature. The fixed index annuity has this index feature where they have the floor of 0 but a cap. And so this is great for somebody who is right before retirement. They're worried that if they stick it all in the stock market, that there might be a 2008 and they lose 30-40% of their money suddenly. I mean, this just happened actually with my cousin. He had a college fund, and I'm not going to go into what was inside it, but it was maybe not managed the way it should have been, and was not appropriate for the time horizon.
I see.
And he got to the time he needed to pull the money out, and COVID had just happened, and a third of the money was missing.
Oh my goodness.
And had they looked at some other more conservative guaranteed options, say like an annuity or other stuff I'm not allowed to talk about, it would have been there. It's just there was nobody watching that account and calling them up every 6 months and saying, hey, I'm worried this might happen, or let's, as we get closer to this, just make it a little safer for you so the money is there.
The college fund you're referring to, is it the 529 plans?
Yes.
I think it's only limited. You can only spend the money on paying back your education loans. Otherwise,
For the kids, right?
you have to pay like 10% penalty or something like that.
Yes, although there was a recent change which was very cool, and I won't talk about it too much just because I need to educate myself a little more on it. But some of the money can actually be converted into an IRA if the kid is not able or not willing to spend it on education. Yeah, it's very cool actually. I think it's a good change.
Yeah, I think I didn't like it because my mom had it, and when I needed for like my car loans or something like that, I couldn't use it, and it's just like all your investment just went poof over the 20 years.
Well, one thing that's actually great on the cash value life insurance front is that it is the only asset you can own which does not show up on the college financial aid forms.
Oh, so you can still get financial aid.
You can still get financial aid. So for all of, I know you guys work a lot with the Chinese community, for all those people out there who are trying to save for college for their kids. Yeah, that does not show up on the FAFSA forms.
So what is it again?
The FAFSA is the financial aid forms. And
which asset doesn't show up?
Cash value life insurance.
Cash value life insurance
does not show up on the FAFSA.
Only the insider knows.
You're right. They might change it if we talk too much about it.
Yeah. So I was gonna continue and talk about what other tax saving strategies are there for you to provide to your clients, other than what we mentioned earlier. So
that 0% tax bracket is really for Mary and Joe, right? It's really for that W-2 earner couple or small business owner where it's actually possible for them to get to the 0% tax bracket. There are going to be some folks who make so much money from their business, and God bless them, I'm thrilled for them. I hope to be one of those people, that there is just no chance they're ever going to get to the 0% tax bracket. They make too much money. And for those folks, they really need tax relief savings now. These are our business owners who are in the 40-50% bracket.
Okay.
And what I do for those folks is pretty different. I would say even less insurance agents are actually aware that this is even a thing. Hell, most CPAs I talk to don't even know it's a thing.
Okay.
I think I've maybe talked to 2 CPAs who have heard about this before.
All right. So what is it?
There's 2 types of plans. One is called a cash balance plan,
balance plan.
One is called a 412E3 plan. It's the IRS code, which is on there. The IRS classifies both of these basically as a pension.
Okay.
And so like an IRA or like a 401k, a business owner can contribute to it and get to defer taxation on that money.
Even for entrepreneurs.
Even for entrepreneurs.
So you don't have to be a high-wage W-2 income earner out there.
Yeah, no, you should not be. You can't be. Actually, you have to be a business owner.
Okay.
And the beauty of this is, let's say, I have a client right now. I was working with. Am I allowed to say his name?
Yes.
Yeah, I'll say. Yeah. So I'm working.
He's been on our show.
Oh,
A
perfect.
CPA friend of ours.
Yeah.
Yeah. I'm working with Jose on a customer right now. And Jose, if you're watching this, I hope it's okay I'm talking about it. Always easier to ask forgiveness than permission, right?
Yes.
So Jose had this client who runs a great business with him and one other person. And I believe that one other person is a family member, actually. And they make about $3.6 million a year. And they have a tax problem because the amount they're paying in taxes is upwards of $1 million. It's like 1.2 million if I remember right. Of course, nobody likes that.
Yes.
Nobody wants 1/3 of their gross income to be going to taxes. And this, by the way, this was after deductions had been done. So there was another CPA who had already done a whole series of deductions. So that 1.2 million was after all the deductions.
Wow.
And our friend Jose was kind of stuck a little bit. He found in his software and kind of going through the tax code a way to save him an extra $50,000. But the client basically said, well, why would I switch all my stuff to you if all you can save is $50,000? My tax problem is 1.2 million.
That's true.
It's not even worth my time to go and get the documents ready to do this, right?
Yes.
We can understand that. This time's very valuable. But I started educating, I'll say a little bit on these 2 types of plans. And we're talking with this client basically about setting them up. And of course, this will allow him to save anywhere between, it'll allow him to defer anywhere between like $200,000 to $800,000 in taxes. And it works very similarly to an IRA, right? You put the money in and it grows tax deferred. And then when you take it out, you pay the income taxes on it. And hopefully when he's a little bit older, his tax bracket will be a little smaller once he's out of business and he's, retired, drinking mojitos on a yacht.
Right.
But when do you cash out? So
59 and a half or older.
I see.
It can also be turned, the cash balance plan can be turned into an IRA. So let's say he funds it for 5 years, which is kind of the minimum I would recommend. I do not recommend this plan to everyone because it is really for a business owner who can consistently put money in for 5 years. If you can't do that, it is not for you. This guy is perfect for it because he makes a very consistent, large income.
Right.
So, yeah, you can at 59 and a half just cash it out like it's a normal retirement account. You can take a lump sum or you can take a monthly or yearly payment. For the rest of your life.
Just like an annuity.
Just like an annuity or a pension. Well, I think, and I'm sure you guys run into it too, kind of in your career. I think there are a lot of folks who get into this type of career And, obviously we're all here to make money, right? And I'm sure all the viewers are here to make money as well.
Yes.
I personally just never believe it's worth selling your soul to do it.
Right.
And that was, my first concern getting into a job like this.
That's
And
why we play by the book.
Yeah, exactly.
Yeah.
Hey, so after you're 59 and a half, you can just declare, hey, I'm retired, and
Yeah.
cash out. You don't have to be sick or injured. You don't. No.
Nope, nothing.
Okay.
You're home free. That's your money now.
I see.
But then, depending on your tax bracket, when you draw the money,
It's true.
that's when you stop paying the tax.
Right. So if you're still in business at 59 and a half, which, God willing, I know most of the entrepreneurs out there want to be in business forever.
Too young to
right?
retire.
You want to make sure that it makes sense tax-wise. You should talk to a CPA like Jose about it. Because you want to stay under certain brackets, right? Why does it doesn't defeat it, but it kind of takes away from the success of deferring all this taxation and you're still in the 50% bracket.
Then is it smarter to take it in a smaller portion, which is like annuity, because then you're taking just a little bit instead of a lump sum?
It depends on the situation.
Do you get taxed more by taking a lump sum, let's say, because lump sum is a big number?
That number will throw you off another bracket.
So it depends how you're taking it. If you're transferring your cash balance plan into an IRA, my dad just did this actually. My dad was an attorney for, goodness, I think 35 years. And he's retired and become a judge in his old age.
Right.
And he just cashed out his cash balance plan from the law firm he was working at and just turned it into an IRA. So if you do that, there's no tax implications on that, right? Because you've moved it from a like account to another like account.
That's right.
You haven't actualized that income to yourself.
This is about your dad. How did your dad retire into another job? I thought.
It's 2024, Tom. Nobody really retires.
I'm retired into a contract.
Bless my dad's heart. He did not like what he did for 35 years. He did the job because he was married and because he had 2 kids and he wanted to provide for them. But it was not what he wanted to do. He wanted to either go into politics or be a professor or a teacher. I could see for decades that it just sucked the life out of my father. He did not enjoy what he did. I think he enjoyed a lot of the people he got to work with. There were times he found amazing people that he would work with and loved and respected. But I don't think he found a lot of the work personally meaningful. Whereas now watching him in a courtroom, he clearly, and every time I see him he talks about it, he clearly loves what he does. He doesn't find it really to be work in the same kind of way. And so I'm thrilled for him that he gets to have this second career where he gets to really do what he wants to do. And for example, he did a bit of time in family law, just last month, and I can tell because he was divorced. My parents were divorced growing up, and so he has very strong opinions about divorce law and how to help divorced couples, right? And I can see that he is working so hard to help some of these couples and families that come into his courtroom resolve their disputes and limit the fighting between the parents to really help them do the best thing for their child and remind both parents when they're good parents that dad or mom is not the devil here. This is mom or dad, and they are trying their best. They might have a different opinion than you about what your kid should do, but they really love your child that you created together, and they're trying their best.
That's great.
Yeah.
Meaningful job. I knew doctors who hated their job too because they have to work it because they have to pay back the loans. Student loan is massive. And then they said he was an emergency room doctor. And he said 90% or 95% of people who came through that door will not actually die if I don't help them. So most of the case, he's just inputting the insurance and doctor dealing with the insurance and paperwork. He's not really saving people. And he now has opened up his own practice as a wellness doctor, and he's just helping people get better. And whatever their wish is, or like if I'm looking for this or that, basically taking care of your overall wellness and set the money aside. I think he really found his passion too.
That's so sad because I know hardly anybody I think goes to medical school because they just want to make money. They really go, I think, because they want to help people get better. And so it's so sad thinking of doctors who are just stuck not being able to do what they really want to do.
Yes.
After studying for it and paying for it.
Yeah, it's long times too.
Yeah.
Yeah, like once you go through that session, it's like you cannot do anything else other than be a doctor.
No, I have a dear friend who she's in the medical field. She's not a doctor, but she's a speech language pathologist. I actually have 3 friends who are speech language pathologists, weirdly enough. But she's the sweetest person I know, and the job pays moderately well. You know, I think she makes $80,000 to $90,000 a year, but she has $175,000 in student loans. And it's going to take like a decade or 2 to pay off. And she has to work at the places where she can actually get debt relief from.
Wow.
And it really sucks because I mean it almost seems, I mean it's good that she's getting the debt relief obviously, but it almost seems like a form of serfdom.
A slavery, modern slavery through education.
No, it really is something like that because if she doesn't work for these pre-approved employers, you know, the public schools for example, she cannot get the debt relief and she will be paying that loan off till she's 50 and her payment is $1,900 a month.
Oh, wow.
That's just like a mortgage.
It is literally a mortgage.
Yeah.
No, it's unbelievable. And of course, as I'm sure you guys know this, I'm very passionate about this, is that unlike normal debt, it cannot be discharged during bankruptcy. In a way, you know, student loans and tax debt are the only, you know, real type of debt, quote unquote, because you cannot get rid of it through bankruptcy. All other debt you can get rid of through bankruptcy. You can start over in 7 years, your credit score will be okay. But with the student loan, no dice. You're never getting rid of that thing unless you pay it off or you get debt relief.
It's interesting how we side steer, but it's still a very interesting topic actually, because all of us bear the loan. I remember when I kicked off my career, my mom gave me $40,000, and it was right after the 2010. A car was $20,000, a Honda Civic, right? Wow. And I used that $40K as a down payment to purchase a $160K home, the cheapest home in Southern California, in Moreno Valley. But that $160K, as the market goes up, because it's real estate, is limited supply towards infinite inflation, so it doubled very quickly in just a matter of like 5 years. But since I'm only paying 20% down, I leveraged 5 times. When it doubled, I made 5 times my down payment. It's very interesting because as I graduated, I had that $40K and it was a house. My colleague of mine, my peer of mine who graduated on the same year, he went on with an MBA degree and it was $80K. Uh-huh. And then as he graduated MBA 2 years later, he was no house and $120K in debt. He couldn't take any lower starting salary job because it doesn't even pay the debt. So and the high-end job, because his lack of experience, also didn't want him. So that was also a big a difference in decision in life. And then from my house, I subleased 2 other rooms to housemates, which kind of pay off my mortgage.
I've never heard this story, Tom. That is really interesting.
Yes.
Now I know why you love real estate so much.
Yes, because literally my tenants helped me pay off my mortgage, and I doubled so quickly. And then because it's a primary residence, mm-hmm. I was able to get $250K, up to $250K free of tax money on appreciation. So it quickly helped me gain that much more down payment to grow. And so since then, I've been in the industry for 15 years, and I changed 5 different houses from the initial $160K up to somewhere up to about a $1 million home.
Can I share something about you actually that
Sure.
you mentioned the first time we talked that I now tell a lot of my clients?
Sure.
The first time we talked, I want to say it was after your networking group presentation, where you showed us how triple net properties work and how tax advantageous real estate investing can be.
Yes.
And I asked you, because you're one of the younger guys in the group like me, I asked you, how do you find all of your clients? What do you tell your people that you're training and you're working with, how to find clients? And you said the most amazing thing. You said, I built my clientele.
Yes.
That most of them were starting out with, what was it, a first-time home or a fixer-upper, and they profited. And then they did that for a while, and then they graduated to duplexes and triplexes and apartment buildings, and suddenly, they're buying triple net properties and restaurants and all that sort of stuff, office spaces.
Yes.
And that thing you said has really stuck with me. And I like to tell my clients that now, and say, especially for the younger ones, our goal right now is to get you started on something and get you into the habit of saving and flexing the savings muscle and using the money, either in your policy or wherever else we put it, to actually go and buy a house, or make sure you're paying off debt, or whatever it is that they need to do to get to that next step financially.
Yes, actually, now that you mentioned, because insurance, you mentioned some policy you can only cash out at 59.5.
That is
for the young people. What is for them?
So that type of thing is a retirement account, right? And those accounts, of course, are very regulated by the IRS. If it's an insurance policy, a cash value policy, and it's not inside, say, a cash balance plan or a 412b3 plan, you can take the money out whenever you want, really. I mean, it's liquid. Especially designed right, on day one, you have access to 90% of the money when it's max overfunded. So, I mean, that is one of the biggest advantages, say, to just stuffing money in a 401k plan. You stuff it in that 401k plan, you're not touching that until you're 59.5.
That's right.
And I know there's some, no knock on anyone here. I know a couple real estate agents who will rip the money out of their 401k plan whenever they need money for a new deal or whatever, and then they pay a penalty and they pay income taxes on it. And I think that's a really good way to be broke in the long term. But actually having an asset like real estate or like a cash value life insurance policy where you can pull money out of it and you're still earning, you're still cash flowing from that asset as if the money were still in there. It is one of the most powerful things you can do because you're just creating one more place for money to compound. The same way when you pull money out of a house from a HELOC, you can still rent it out to other people and earn money from it.
Yes.
The value of the house can still appreciate as property values go up.
Yes.
In the same way, with the right cash value policy, where the loan amount, the loan interest rate is below what you're being credited, you are still compounding on that money. The compounding does not stop when it's done right.
As we are about to wrap up, I know different policies have different features. Everything comes down to contract. When you review a contract,
yes.
What are the key terms that you look for, and which type of product is suitable for which people in which situation?
Well, I'm going to avoid the word suitability, just because that gets into the securities licensing stuff, and I want to be respectful of all the compliance stuff around that. But the first place I would look when I'm looking at an illustration, and I get sent a lot of illustrations by people who want me to check to make sure their policy was set up right. The first place I look is the cash value accumulation column, because you're going to get a really big ledger, and it's very daunting actually in the contract, where you have this ledger of all these different numbers, and there's a death benefit on the far side, there's the cash value accumulation account here, and then there's how much you're paying and a bunch of other stuff. And most people look at that and they're terrified.
Yes.
I look right at that cash value accumulation account, and then I look at the premium. I want to know how much they're putting in year one and how much access they have to the money. Because if they do not have access to, let's say, 70% or more of the money, ideally 90%, I know that policy has not been designed right. If that policy does not break even for 10 years, I know that policy has not been designed right and the agent has designed it to maximize their own commissions. Or the agent just did it out of ignorance. But when the policy is designed properly, you have access to that liquidity immediately for 90% of the money, and it's breaking even somewhere between years 4 and 6. On certain institutional products, which are available for people over certain net worths or certain types of business arrangements, it actually can happen even sooner, where you can have, it's broken even on year 1. But that is a very particular type of person. That's not going to be most people. Most people should expect it to take about 4 to 6 years for it to break even. But the nice thing is you have access to most of that money for the time. You're able to use it. You're able to compound it even while you're using it for other things like real estate purchases.
Yeah, one last question for you.
Yeah.
So, I hear from other insurance agents about life insurance.
Yeah.
Most insurance covers about the death benefit.
Yes.
And
yes.
few of my life insurance agent friends mentioned about their policy has living benefits. Can you talk a little bit about living benefits?
I can. Just know, up front that living benefits are oftentimes what's called a rider on a contract. So there is a base contract, and then there is a rider on top. So you are paying for those living benefits.
Sure.
So off the bat, I want to make that very clear. However, some contracts offer very reasonable costs for some of these. I would say especially for women who are looking for permanent long-term care coverage that is paid off by the time they retire. Having a cash value policy with a long-term care component is amazing.
I see.
Because you're actually getting the long-term care money from the death benefit. So it is such a great policy for people because there's this cash value component where you're growing your money. There's the long-term care component if you get sick and you're not able to do the normal activities of daily living. And then there is this component of death benefit. So whether you're healthy and life is good, you can use the money. Whether you are sick and you're incapacitated or you have dementia or whatever, you can use the money. Or if you die, your family can use the money. And it passes tax-free to the heirs. So I am a huge fan of that. It can be amazing for people. I literally just had a friend, agent from another company who it wasn't long-term care, but it was chronic illness coverage. Legally different, but can provide somewhat similar benefits. His father had a heart attack, and very young. His father was, I want to say, in his early 50s.
Oh wow.
Yeah. And he had this life-threatening heart attack, and the policy paid them, I want to say it was $300,000, $400,000 to be used for whatever they want. The biggest difference actually with the living benefits on a life insurance policy versus, say, having a traditional long-term care policy. A lot of the time with traditional long-term care, you're paying that forever. With the life insurance, it's paid off whenever you want it to be done, and the policy can self-sustain.
Right.
And the cash is given once the doctor says you can't do these things.
Oh wow.
It's given in a lump sum or monthly payments, and they aren't going to check what you spent it on. If you decide it's a really important thing for your cancer-ridden mother, or she decides it's a very important thing for her to have a Cadillac, she can go buy a Cadillac with that money.
Oh wow.
The insurance company does not care. And I love that because it gives individuals agency over how they're going to spend the money. There's not going to be an insurance company standing over their shoulders and saying, hey, I don't like this hospital you spent money at, or I don't like that you got a home health care aid, or this person is licensed or unlicensed to do this type of care. It is, do you have these things? If yes, and your doctor says so, here is the money. Spend it how you want. We are going to treat you like an adult, and you can make an educated choice about how you want to spend that money.
So do you offer living benefits for most of your clients, or is it an option, or is it optional?
I like to add it for anybody who has a family history of something. There are going to be young, healthy, wealthy clients who feel very strongly that they are never going to get anything that will disturb that. For some of those people, you know, it's up to them. I feel like I'm a bit of I'm not going to tell them that they must do this if they want to work with me. Because again, there is a rider charge on a lot of these things, especially the long-term care. But for some folks who care about that, and care about not being a burden on their family when they're old and sick, and I think that's really perfect for them. I forget the exact number, but it's quite high. I think I talked about it in the BNI presentation, but I want to say it's either 1/4 or 1/3 of people who make it over 65 have a serious long-term care event that is longer than 6 months. It is extremely likely to happen to most people if they live long enough, and every year that they're alive, it's way more likely to happen than the year prior.
It's just like the saying in riding motorcycle. It's not whether you will need it, it's when.
Yeah. Well, to summarize Joseph Green's approach to his clients, he cares about what initially, do you have access to the money, to the policy. So he cares about the cash value, whether you have access to it or not, or when it's time to withdraw, whether if it is borrow against it, and then the interest rate is lower on the payback than the credit.
Exactly.
Right? Definitely, if you are considering something other than real estate investment, you want to have some defer your income tax and also get some money or protect your ass when you keep the You know, definitely give Joe a call.
Or reach out to one of us. We'll refer you and introduce you to Joe.
Never hurts to ask.
Thank you for your time, Joe.
Thanks for having me on, guys.
Nice meeting you again.
And until then,
See you on our next CRE More.